let's get started. Knock, for all of you that don't know, they have two separate programs. I'm going to cover both of them. The first one fairly quickly. It is the Knock Home Swap. It is if your buyer has a home to sell before they can buy. So that's the only time that you will use this Knock Home Swap program, is if they have a house to sell first. Okay? Knock has made this entire process fairly, as simple as it gets. You do have to get certified. All of you should do it. It is a 30-minute webinar that you sit on, and they will go over the programs with you.
The agent has to get certified, not the home buyer.
Correct.
You have to get certified.
If you don't get certified and you try to send your client to Knock, Knock's going to send it to one of their certified agents. So all of you should just go in and get certified. It takes no time at all. Knock has come up with a new app. It's called the Home Pro app. So in this in this home swap, the first step is you enter your client information into the app, and that is what ties you to the client throughout the entire process. So they won't give your client to somebody else. With the home swap, the next thing you do is you enter the home that they have to sell, that address. So once you put the address in, it'll say, yes, this home qualifies for their home swap program, which is Knock will give you time to sell that home after you buy yours. The third step is you invite the client to submit a loan application. Okay? With Knock, one of the big differences with Knock is in both programs, Knock is your lender. They are the buyer's lender, period. No one else. All right?
What if they don't want to use Knock as their lender? What if they have a lender that they're working with?
They will not be eligible for the home swap program. And the other program, the Knock Go guaranteed offer program, I'll get into that in a bit. So there are you don't have to use their lender, but all of their guarantees go away if you decide not to. After you do that, the client gets their application submitted. They are approved to get their mortgage. Then you will go into the app and you will submit a home condition report. And what that is that looks exactly like EZ-Sell. You go in the app, you're literally going to walk around the house filling out information on the app about the condition of the home, what's in the home, taking 2 pictures of every room. And then you submit that. After that, you're ready to go find a house. You are approved. Go ahead, Casey.
So this was a part of the EZ-Sell program. Is it still?
It is still part of EZ-Sell. This is bridge financing is what this is. All right, so there are other bridge financers as well. That's why I'm not going to dig too deep into the bridge financing part, but I will answer questions if you have them, Julia.
The pictures that you take, are they the same ones that EZ-Sell? Like, do you need to get under the kitchen sink and?
You will, as you're going through the app guides you. Oh, okay. Julia's question is are the pictures the same as the EZ-Sell requirements where you take under the sink and you get the labels on the HVAC system, that sort of thing? The app will walk you through all the pictures you need. There is no way to miss it. It'll say bedroom, take 2 pictures. You walk in, take a picture, take another picture. Second bedroom, take a picture. So the app walks you through it. They've made it very seamless. Amy?
Is there a certain time frame in order to buy, like if they want to buy a new construction, is there flexibility on that, especially with the delays?
Knock will not do new construction unless they have a certificate of occupancy. So you can't put in an offer on a to-be-built home because of the delays. They have no idea how long it's going to be. The pre-qualifications expire after so long. You get into just way too many obstacles.
Okay.
Fair enough?
Yeah.
Mr. Rip?
And sorry if you said this, I was looking up the app, but there's not a fee other than having to use them as your lender for this.
With Home Swap, there is not.
I don't think so.
I don't believe there is a $14.50 lender fee, is there? No. There's no lender fee. There's no nothing with this one.
Is that on Home Go?
Not on
The
Home Go.
Knock Home Swap? No, the Knock Go I'll get to in just a minute.
So there are no fees?
No fees
for that.
for home swap.
So they make their money off of the interest of the loan.
Yep.
So are they a little bit higher?
Interesting you say that as you go on the,
Okay, hold on, let's get you right
Yep.
back then, Richard.
Yes.
Okay?
So Pedram's question is, how are the interest rates? As you go on the app, the Home Pro app, it tells you Atlanta rates currently at 3.875% is what they say. So not the best, not that great either. But I'll talk about that more in a bit after I go through the Home Go. Any other questions on Home Swap? All right. Let's talk about the Knock Go, which is their guaranteed offer. This is their quote unquote cash backed offer. This is only for when you're buying a home. Okay, so if your client's just looking to buy, they don't have anything to sell, I'll make a note on this. Your purchase and sale agreement cannot be contingent on the sale of a home in this program. If that's the case, you need to be going through the home swap. All right, so key point there. With the Knock Go, you add the client to the Home Pro app again to tie them to you. It's real easy. It took me about 30 seconds to add my wife. Then you go in and you invite the client to submit a loan application. Okay? The application is a full loan application. It's one of the reasons we can't do the Power Buyer program. Jot up that algorithm real quick with Mike. So the loan application is submitted. This loan application process, it is pretty much full underwriting approval. You're just waiting on the house at that point. Okay, so there is minimum, again, you're fully pre-approved. With your offer, there will not be a finance contingency. So Knock guarantees this closing with cash. Does that make sense? Anybody have questions on that? You do not have a finance contingency with Knock Go. Okay? Knock guarantees the offer with cash, and I'll go over some of the issues, the things that can come up that will prevent them from backing it with cash in just a minute. But go ahead, Casey.
And Knock is going to be the lender on this deal?
Knock will be the lender, correct. Knock is always your lender. All right, that's their primary objective. They're going to make the money off the interest in the sale of the mortgage. Okay? And because they back it with cash, you have a guaranteed closing date. So there are no extensions. As long as you meet all of the criteria, if the financing isn't ready to go, Knock will jump in and pay cash for it, and then they will fund it with their cash, and then they'll give the mortgage. Go ahead, Mr. Lanier.
What's their window on closing dates? How far out can you?
Okay, so the window on closing dates, I'll get to that in just a minute, was the question. Mr. Casey?
So no financing, what about no appraisal?
I will talk about the appraisal as well here in just a minute. So, good question, though.
So if they come in and sweep like 3 days before closing, it doesn't look like you're going to, and they come in and buy it, is there a delay on when the person can move in?
I don't have a definite answer to that, but as far as I understand, no, there is not. So I'm 95% sure on that. All right? Other questions? All right, let's talk about the appraisal, like Casey asked here. Knock has an appraisal protection, okay? So if the property doesn't appraise, they will cover up to 3% of the loan amount. That's the loan amount, not the purchase price. So for instance, if you buy a $500,000 house and it appraises at, or you have a $500,000 house, they're putting $50,000 down. You know what, let's not get into numbers because I'm just gonna confuse you all, right? So it's up to 3% of the loan amount on it, okay? That they will guarantee, they will pay for, okay? It gets tricky, it's up to 3% because there are multiple levels of criteria. And in that criteria, your loan advisor that you're working with will tell you all of the options. Mr. Cupp?
Regardless of loan value?
Regardless of loan to value. Yes, ma'am, Ms. Leanne?
Do you actually, does your client actually get paired with a loan advisor, a human?
Yes. The question was, does your client get paired with a loan advisor? And yes, they do. Mr. Casey?
The 3% is part of that depending on how much the person is putting down to purchase the property.
It is because of, it's the loan amount and not the purchase price.
Okay, but like they're not doing a thing where they just say like, let's say you're putting 10% down. Or like, okay, well, we'll cover 3% and you drop it to 7%. You still pay for 10%, but you're only going to get 7% of that.
No, it doesn't change the loan to value ratio. Anything over that up to 3% appraisal gap, your customer, the buyer, will be responsible for. So the question came up, do you need an appraisal contingency? I would say yes, you're going to want an appraisal contingency, especially if you're worried about the property not appraising. If you've bid $50,000 over because you're in a super competitive situation, there's 150 showings and you get into all that. Make sense? Mr. Ripp?
So we could do an appraisal contingency, and then we could figure out the numbers and put in an appraisal gap shortfall of whatever that 3% would be. Does that make sense? Can we do that?
Yes, you can. That you're getting outside of the scope of what the appraisal gap coverage is. This appraisal protection, the gap coverage, NOC is going to pay it, so you're asking on top of that, you're wanting to?
No, I was just saying, so when you submit a property, we're going to have to put an appraisal contingency on there to be safe, but we know that they're going to cover up to 3% of the loan amount, so could we not put that so that the agent knows, the listing agent knows, hey, if it's over this much, it's covered?
I think you are adding extra into the contract that's not needed. But yes, if you're trying to make your offer look more competitive, I suppose.
Yeah.
Does that make sense? Other questions? Mr. Pedro?
If it's over the 3% that they cover, can they bridge it into the loan?
No. The buyer will have to bring the cash over the coverage amount. Again, you may still want an appraisal contingency. I would get one with this NOC Go program to get the appraisal contingency. Let's talk about the financing terms with NOC now. There are no origination or program fees for this either. Okay, so there is no 1 point on the mortgage, so it's 3.875 is their current rate, but they charge 0 points. They do have a $1,450 lender fee. That is their funding as well as underwriting fee all combined. So the only fees that you will pay with NOC is a $1,450 lender fee, and that's if you close. They don't pay that up front. They don't do anything like that. It's on the settlement statement as a lender fee. The buyer is responsible for all other closing costs with regards to their loan, including appraisal. Sound good? And NOC may match competitors' rates. And it says may up there because they're going to want to look at it apples to apples. If you get a lender that comes in at 3.5% versus their 3.875, but they're charging a point for it, it's not apples to apples. Any other questions?
Okay, so let's break this down real simple, okay? First, they say there's no origination or program fees, but they do have a $1,450 lender fee, okay? So eroded by any other name, right? So that's if your people are buying a $500,000 house and they're putting $100,000 down, what's their loan amount? $400,000. How far over purchase price will not go? $12,000. Right. So they would go up to, what's the final price that they would go up to?
580 or 4.
512, right? Everything over 512, your buyer is responsible for bringing cash to the closing table.
That'd be just the opposite, Mike. It's 488. So if it appraises short at 488, they will pay the seller the extra 12,000. They'll make up that gap up to the 3%. And this is where it gets into you need to speak to the loan advisor because of all the other. I don't think I,
Okay, no, let's just move on, okay?
yep. All right. So where's the gotcha? What's the catch in all of this? First off, NOC is your lender. You can't use any other lender. If you do, you can go out and shop it. You could potentially change lenders, but all of the guaranteed offer stuff goes out the window if you're not using NOC specifically. Buyer must, you must have a valid NOC underwritten pre-approval prior to signing a purchase and sale agreement. So you need to go through all the first steps to getting pre-approved, which includes uploading documents, pulling credit, and getting them fully underwritten. So you must do that up front before even submitting an offer. They're qualifying the buyer, right? The loan cannot change after the signed contract. So if you change the loan terms, they can remove the guarantee. So the buyer needs to know exactly which loan they're getting and what they want to do. You as the agent, you have 1 business day to turn in that contract. If you don't turn it in, they could lose their guaranteed offer. So make sure I think that's pretty typical anyways. We should all be turning in our contracts within 1 business day, here to the office within 1 day. And then the big catch you, the big I got you with the buyer is they must supply all documents within 24 hours of NOC requesting. So I need your bank statements. You got 24 hours, your clock starts. If you could control your buyers through this process, I don't think we'd have nearly as many delays with financing anyways, right? Questions? Rip?
So if I show a house this morning, my buyer's like, yes, let's do that, and I haven't done the stuff up front, they just decide to do that, what kind of turnaround time if we get everything turned in quickly, what kind of turnaround can they get pre-approval and all that to be able to make the go offer?
Within 48 hours of the buyer submitting all the documentation in their application.
Is that business days?
I would guess it's business days. I saw 48 hours, so.
So really your best bet is have
Do
the
it now.
conversation and
Have the conversation up front, especially if you've lost out on multiple deals and now we're implementing this and we want to take this action to try and get this done. Ms. Manuela?
So if I have a buyer that uses the Go program instead of selling her home, what is the prepayment penalty?
The prepayment,
Sometimes you can't pay a mortgage off within so many months.
to my knowledge, there is no prepayment penalty, but I don't know that for 100%. I don't think prepayment penalties are really a thing in the mortgage industry right now.
They're not.
Go ahead, Mr. Lanier.
I know with Ribbon, they can kind of control how much you can offer on a home. With NOC, do they care how much you offer or just?
They don't care how much, so the question is does not care how much you offer for the home? No, but take into consideration the appraisal gap as well. NOC will pre-approve the buyer for the maximum amount that they can get qualified for. So you'll know kind of what their limit is as far as that goes. I saw 2 half hands. Mr. Casey?
At what point in the process will you know how much of that potential 3% appraisal gap coverage they would be willing to cover? Is it before you write the offer or after?
It's at the time that you get the appraisal back. The actual appraised value comes into consideration. So, Miss Amy?
Can we get an idea of what that appraisal contingency would look like at the beginning of the offer with this program,
So
if that makes sense?
you'd put a finance contingency in.
That's the question.
Oh, okay, so the question is what would the appraisal contingency look like? It's just your standard GAR purchase and sale with the finance contingency. It'd be 0 days finance and however many days appraisal that you're going to use on page 2 of that. Mr. Cup?
All all loan products are available, USDA, VA, FHA.
The question is what loan products are available. To my knowledge, it is VA, FHA, and conventional are all options. I did not ask about USDA. So, other questions?
Okay,
All right.
let's look at a different type, similar but different. Jen, you're going to talk to us about ribbon.
Yes, sir. Okay, so Ribbon is a similar program with similar products. Here's the key difference. Ribbon could care less who the lender is. They don't want to be your lender. They're going to rely on you and your client to supply the lender. They want to know that up front, and that will guide their course moving forward. Okay? So Ribbon does not care who your lender is. They have 3 products. The first one is Ribbon Boost. The equivalent to this would be the Knock Go program. It is simply a way to, if your buyer has no other home to sell, this is the easiest way to do this, and it's a simple cash option program. We're going to talk more details in a minute. The Ribbon Reserve is the rent back for up to 6 months period of time. Ribbon Rescue is you're under contract, your lender has failed, your current buyer's lender has failed, and you need a rescue service to come in and resurrect this thing from the ashes. That's what Ribbon Rescue is. Okay, it's basically an accelerated program of the Ribbon Reserve. We'll talk more details in just a second. Okay, the Ribbon Boost is Ribbon backs your offer with cash and the appraisal protection to make it stronger. If you secure your financing with your lender, with your buyer's lender in time, great, no problem. You close with that lender and you don't have to exercise the cash option, and your client moves in right away. Simple as it gets. This is perfect for simultaneous closings, securing your next home and then list the one that you've got. It works for this. Here's the downside is if you do end up using this, you got to sell the other one in time. It would be a sale contingency type scenario, and you would be really putting your client in a potential disadvantage if you used it in that capacity. It also works great for multiple offer situations to remove any finance contingencies, appraisal contingencies, and home sale contingencies with it. The fee for the Ribbon Boost is 1% of the sales price of the house. Okay? So in this scenario, because Ribbon is not the lender, they're not making money off of interest rates, they're not making money off of ancillary services like title companies and things like that. So the fees for Ribbon tend to be slightly higher. What questions do you have before I move on to the next one?
Okay, so let me see, I think we skipped over a little part here. So I'm buying the house, I've used the Ribbon Boost program, they buy the house with cash, they just give me the cash?
So the way that, I've got this towards the end, the way the program works is I submit, Amy's my client, I submit Amy. Amy, we actually provide them the pre-approval letter from Amy's lender. And they give you your buying power. And they say, we'll back Amy's qualified, her buying power is up to $350. Then Amy and I go shopping, we find the house, we submit the house to Ribbon. Ribbon does, for lack of a better term, a desktop appraisal and say the house is listed at $325. They will come back and they will say, we'll back your cash offer up to $350, which happens to be her same pre-approval limit. That's how Ribbon gets away with removing the appraisal contingencies, because they've essentially already done one. And they're confident that it's going to appraise at whatever they've told you your cap is.
I think the key point here is you never use Ribbon cash. You just pay them a 1% fee for having the cash backing.
Correct.
You got your offer accepted, you made your offer more competitive, and you paid a 1% fee to do that. Is that right?
That is exactly correct.
And you pay the 1% regardless if you close with them or your own lender.
You never touch,
No.
you never touch Ribbon's money. They just
Yeah.
had their
You just had their
So
backing.
You just had the backing, but close with your own lender, no
Yep.
1% fee.
Yep. So, I mean, I'll give you a great scenario. I mean, I had a client that was a VA. Not a very strong presentation in a multiple offer situation. Pitched this to him, you know, he was looking at the $250,000 price point, $2,500, not bad to be able to win a bidding war.
My listing just sold to Ribbon in December.
There you go.
Okay, so Boost is just to have the back, you never use it.
Correct.
And you do pay 1% fee, right?
So the fee is handled in the form of the earnest money. Okay?
So, wait, to get that clear then, you think you do pay it regardless?
Pay 1% fee, don't you, Jay?
Yeah, you pay that fee regardless.
Okay, because I asked that a second ago,
And that's what you said when you asked me. That's what you said. So if we do this, we pay the 1% fee. I don't think that's what you meant. If you do this, you're paying a 1% fee for having the backing to your.
regardless.
Regardless.
Yep.
That was my question.
You never
Yep.
used any of Ribbon's money.
And that fee is taken out of the earnest money, which they have a requirement that the buyer submit the earnest money. Yes?
When you write a contract, do you write a cash contract, or how do you write it?
These folks also use an app and a website, secure website. They literally will provide you with the instructions on how to write the offer, how to fill in the cash exhibit. They literally provide everything for you in that process. Would you do an appraisal contingency is the question she asked. In this case, no, because you've already got Ribbon's approval. As long as the appraisal, as long as your sales price is less than what they've told you that they will back you to. So in Amy's scenario, 350,000. If I write it to 350 and they say Amy's approved up to 350, then you don't need the appraisal contingency because they will pony up if they need to. Linear.
If you feel like you have to go above what they tell you they'll do, so let's say you feel like you have to go to 365 to win that house, you're gonna have to pay $15K extra in earnest money, I believe. They want it up front.
Yeah.
So it gets a little tough there.
Oh.
So you may want an appraisal contingency?
It depends on where what sales price you're offering.
Okay.
Okay? Ribbon Reserve, I'm sorry. Trevon.
So, I heard this part of Ribbon has changed with respect to how much they back something for. So let's say they back it up to 350, the sale price is 325. Your approval is 350, so you offer it 350. Appraisal comes back and it's 340. They usually eat that 340 to 350. Is that changing or is that still the same?
Still the same.
Even if you use your own lender, they'll still cover that.
Yep.
Now, you're saying that they'll take the 1% from the earnest money.
Correct.
Do they have a minimum?
Yeah.
How much earnest money?
The earnest money minimum is typically 2.4%, which ironically is the fee for this option, the reserve option. So that's where they're getting it from.
Now, I'm gonna ask, if you have a question, please stand up and speak up so people can hear. Okay?
Thank you. Anything else before I move? Okay. Ribbon Reserve is basically, it is exercising the cash option, and Ribbon is going to come in and buy the home for cash, rent it to your buyer for up to 6 months while they secure their own financing, while they're selling their other home so that they don't have to do the sale contingency. Clear as mud? Okay, this is perfect for closing fast. Ribbon can close within 14 days. Reserve the home with Ribbon, move in immediately, and get up to 6 months to secure the financing or to sell the other home. Buyers who need to sell first, use Ribbon to reserve your next home, move in immediately, and get that 6 months to sell that one.
Is that how fast they can? Is that how fast they can close on without the reserve, whatever the
Yes.
That one's up to your lender, isn't it?
Well, yeah, if you're going to use the lender, yeah, you're absolutely right.
Guaranteed off, yeah.
Yep.
So if they're moving from out of state, would that work? Like if they're selling a house in another state and they're moving to
It can. It depends on if Ribbon exists in the market they're moving from. So you will have a Ribbon representative that you can, it's your designated, just like in the NOC, the loan officer, you'll have a Ribbon rep that you can address those kind of questions and ask the specifics about that particular market. Okay, the fee for Ribbon Reserve is 2.4%. And again, that is pulled from the earnest money that is deposited.
So that's
Lanier.
selected at the time of the first contract.
At the time of the first contract. Yep. Okay. And to be clear, when you buying it, for the 6 months, you make it all the way to the 6 months and you end up buying it, you're buying it for the exact same sale price that Ribbon bought it for.
Is that 1%
Steve.
added on to the 2.4?
No, it's 2.4 instead of 1%.
Is the rent determined market rent or based on potential mortgage payments?
When I submit the home, Amy's my client, and I submit the home that Amy wants to buy, they will come back with what their offer price will be and what the rent will be for those 6 months. So it is full disclosure, full transparency up front. She'll know up front.
In your experience, do you feel it's typically escalated or pretty fair?
It's market, maybe with a slight margin above that.
Okay.
But you're getting the convenience of what you're, accomplishing the goal that you set out at the beginning. And a lot of people, that's all they want. Pedram first.
Do you need lender approval prior to getting it done?
I'm sorry, we couldn't hear you back there.
Do you need lender approval prior to getting with Ribbon?
No. However, there is something, what's the term?
Identity of interest.
That's the one. Thank you very much. There is something with FHA where basically FHA thinks that they're getting smarter about this, and they're doing this identity of interest, and they're basically trying to put these guys out of business. I don't think, it all depends on the lender and the program that they're plugged into. So that's why you would submit your pre-approval to Ribbon at the very beginning, so you would even know. And theoretically, they're identifying at that time. Steve?
The rental, to rent it back, do you go through this like standard thing, first month, last month, security deposit, all of that?
I don't think so. I think it's pretty cut and dry. It's just the prorated rent for the amount of time that you're gonna have it there. Okay, Casey?
So what I'm hearing is basically if it's conventional, don't really need to worry about that much, but pay very close attention if it's an FHA deal, double check that with it and make sure.
Yeah, that's probably a fair statement, but I'm fairly confident that when you turn in that pre-approval letter, they will identify if that's one of the programs that has the identity of interest clause associated with it that would be problematic. Okay? Lanier?
Yeah, Ribbon's rep will reach out to the lender. Ribbon's rep will contact the lender and ask, is this okay? And make sure it's good.
How many have you done already, Lanier?
Successfully?
Yeah. I hear you, loud and clear. Trevon?
Kind of a disclaimer, whenever you do the Ribbon Reserve, you don't have an option for fixing the amendments to address concerns. Ribbon needs those things completed before your person can take possession of the home.
And we're thank you. We're going to get to that, but yes, he is correct. Okay. The Ribbon Rescue is basically Ribbon Reserve on steroids and accelerated timeline. And it is in the scenario where your financing for your home has been delayed. Ribbon can close within those 14 days, reserves the home, you move in, you rent it for that period of time, and then you have 6 months to be able to rescue it. But it's basically an accelerated timeline because your deal has gone to hell in a handbasket and you have got to figure out a solution quickly. This can be it, okay? And the fee for it, as opposed to 2.4, is 3% of the sales price of the house. Okay? Again, it's high, but could it work for somebody who's fallen in love with their dream home and sees it crashing because of some factor that they can't control about the lender? Can work. Miss Julia? Okay. How it works. All steps are through the Ribbon web-based portal or their mobile app. You get the buying power and a home valuation. Ribbon backs your buyer with cash to win. The Ribbon offer is accepted. Here's the caveat to this. When you go binding on your contract, one, you have to have 7 days of due diligence. You can't go any less than that because Ribbon is using that home, basically the home that Ribbon is putting the cash offer, it's collateral for them. They want to make sure that the value is there. So you have to do an inspection, you have to turn it into Ribbon at that point. And Ribbon comes back and says, here are the following things that may need to be done, okay? Until that time, even though you've got a binding contract, until that time that the inspection has been done and you've negotiated it, Ribbon has not formally accepted your offer yet. That's the caveat. None of their guarantees come into play until they've reached that point. Okay? Then you go on your closing day, Ribbon purchases the home and reserves it for your client, and then they pay the prorated rent for that rental period. Julie.
So can you use this on communities or whatever that has a rent restriction?
I don't think so.
You can use the guaranteed offer, the boost, but
Yeah.
not the other two.
Yeah. Lanier?
They also, if the seller needs temporary occupancy, it's also a no-go.
Yeah,
They can't do temporary occupancy.
correct. Trevon?
That just changed.
Did it?
Did it really?
Last week. Last week, yeah.
That's new.
21 days?
All right, and then the last step of the process is you basically buy it back from Ribbon. You are not making any money at this closing, you're making money at the first one. Okay, so there's no double ending the deal. Does that make sense? Julia?
Julie, we have like a 20-question maximum.
Go ahead.
Nope, we're done. Okay, anybody else? Okay, hey, Jake and Wade went to a lot of trouble with the in-house subject matter experts on this. Would you give it up for them? So good job, guys. Hey, a couple takeaways